Thank you for joining us for our second quarter outlook. In borrowing one of our major themes for 2016, the title of the second quarter is Don't Change Lanes. And in this context, we're referring to asset allocation because the first quarter presented investors with ample opportunities to try to change lanes by selling equities. And certainly some investors did. If you look at the performance of the S&P 500 over all of 2015, and then this V portion is 2016, you may recall that we began 2016 with the worst January on record with the market down over 10%. That was followed by the biggest rebound and reversal since 1933 where all was gained back. Now, the root of the sell-off in January of this year as well as August of last year, and there's a real symmetry between these two, were China growth scares. The Chinese devalued their yuan in each case and sent shockwaves around the globe with investors being concerned about how slow the Chinese economy was going to go, whether they have a hard landing or not, essentially. And China, of course, is rebalancing their economy. They're transitioning from a manufacturing-based economy to a consumption-based, but the transition is slow. If you look at this blue data series here, this is the value of worldwide exports, and it's declined over the past year. But this is a dollar-valued index. So, yeah, the total value of goods exported has declined, but that's primarily because oil prices and commodity prices are down, not volumes. And as far as how China fares in this, if you look at China's share of world exports here in the green series, it hit an all-time high at the end of the 2015 at 15% of world exports. So, yeah, China is transitioning, but it's a slow transition. We don't think it's a hard landing. Until further notice, our economy is slowing, but it's modestly as they readjust. So again, we don't think they're crashing. It's just more rebalancing. As far as the global landscape, though, the manufacturing sides of not just China's economy, but the U.S. and Eurozone, it's been declining for some years. And as a measure of that, we look at the PMI, which is the Purchasing Managers Index. This measures manufacturing, but it's a good leading economic indicator for the economies as a whole. And you can see through 2014 and 2015, these three major zones in the world, China, U.S., and Europe, all were declining until recently. In recent months, we've seen what we hope is a bottom and actually a trending up here. Anytime there's a reading over 50, that means we're in expansion mode. We're that way in all three regions at this point in time. And this is something that has helped drive equity prices higher, is investors looking at the data. The PMI is a good leading economic indicator and giving investors some confidence that maybe the world economy has put in a bottom here as far as how slow things are going. Now, it's maybe not off to the races, and it remains to be seen if this is sustained. But for the time being, PMIs are starting to pick up and bolstering investor confidence. As far as interest rates go, though, in a very slow growth landscape around the globe, rates are low. If you look at rates, and these are yield curves, hard to call this a curve, it looks more like lines, but here you see four different countries in Europe, and it's very similar in all cases. Here the zero line indicates how far out you have to go in years before you get a positive return on your bonds. So in other words, you have to go out to almost 5 years in France and Austria and Finland and Denmark before you actually get a positive return on your sovereign debt. If you look at Japan, it's even worse. You have to go out to 10 years in Japanese debt before investors get paid a positive return. Extraordinarily low, an all-time low as far as the Barclays Global Bond Index. The global average is 1.3%. So rates are incredibly low, and this has implications for U.S. rates. If you look at the U.S. yield curve, it's all in positive territory and positively sloped, but it's lower than it otherwise would be because of the pressure from the other parts of the world where rates are so low. So this puts a lid on rates here in the U.S. We think rates will climb higher. Right now, the yield on the 10-year is about 1 3/4. We think that it will trend higher towards 2 and north of 2 as the year progresses, but not dramatically higher because of what's happening abroad. In terms of the U.S. economy, we're not the least bit worried about recession here. Things are on good footing in the U.S. and continue to get better. As the title suggests, the pillars, the foundation, if you will, of the U.S. economy, jobs, unemployment's still less than 5%. Wage growth, over 2%. Housing, consumer spending, and confidence in great shape. And savings at approaching 6% is the highest it's been in many years. So we feel good about the U.S. We're not the least bit worried about recession here. In terms of the equity markets, Oil's really set the tone over the last 6 months. Here we see what WTI has done, and we know over the course of last year, oil prices declined until recent months where they hit a bottom just north of $25 and are now approaching 40. What's been really extraordinary over the past 6 or 9 months is how correlated stock prices have been to oil prices. Oil prices really became a proxy for investor fear. As investors got more confident, they bid up oil prices and bid up stock prices and vice versa. Fortunately, as oil prices have gone up, so have equity prices this year. The linkage, the correlation, if you will, has started to diminish a little bit, but nonetheless, the higher oil prices have helped equity markets. They've been a sign of greater investor confidence in the health of the global economy. And as we've outlined before, we remain constructive on oil prices, and that will help stocks. And probably more importantly, it'll help earnings. Because as we pointed out, at this point in the cycle, for stocks to go higher, earnings have to go higher. And for the last 2 years, earnings on the S&P 500 have been stuck between $116 and $117, and therefore equities went nowhere. As we ended 2015, the expectation for earnings this year was $125. That'd be a nice improvement from $116 last year. Well, revision activity has been negative. In January, the expectations consensus on Wall Street fell to $124. In February, they fell to $121, and right now they're at $120. That's still a pickup from last year and the year before, but the trend has been negative. At this juncture, we think that expectations are actually too pessimistic, that given what we've outlined before here in the previous pages for an economy globally that is put in a bottom and starting to accelerate a little bit, we think we're going to get some positive revision activity, first and foremost out of energy stocks, perhaps industrials. The point is we think there is going to be positive revision activity here north of 120 as the year progresses, something that will be a foundation for higher equity prices. Finally, to the title of the outlook, the Don't Change Lanes, referring to what has worked and what hasn't worked in stock markets over the last 2 years. Value has not done well relative to growth. We employ a relative value approach, and so value stocks have lagged. The gap has never been wider as we entered 2016 than it was. You can see the PE of growth stocks versus value stocks are tremendously wide going into 2000, at least they were going into 2016. They started to narrow, and so far year to date, value has outperformed growth. In other words, those FANG stocks, if you will, where we caution investors not to chase those, that we thought that they were overdone. We're starting to see the rotation back to value. We're staying true to our discipline, and we think we're going to be rewarded for that further as the year progresses. So to summarize, we think stocks will do better than bonds. We've moved to neutral in emerging markets. Emerging markets so far have done quite well this year. We've gone, as I say, to neutral, not overweight at this point. We still, among the developed markets, favor the U.S. and Europe, and we remain underweight commodities with the exception of oil. Thank you very much for your time and attention. We hope you have a great spring, and we look forward to catching up with you in the summer.